How do credit card interest rates work? Nobody really likes paying interest rates, but there's a reason they come with your credit card account. So what is credit card interest? It's basically the cost of borrowing money. It's a percentage you pay on the balance you carry based on an annual percentage rate, or APR. It's usually charged on the last day of your billing cycle, the statement closing date, typically 21 to 24 days before your payment due date. There are also different types of interest rates. Variable interest rates change over time based on a benchmark index rate, which moves with the market's economic conditions. Often this index is the country's prime rate, which is based on a number set by the government. A fixed interest rate doesn't change with market conditions, always staying the same. Introductory interest rates are sometimes offered to new cardholders and remain in effect for a specified amount of time. For example, a 0% introductory APR for the first 6 months. Finally, promotional interest rates are just like introductory APRs, except they're not just tied to a new credit card. They can happen with balance transfers, holiday seasons, or any other time a credit card company wants to reward your spending behavior by offering a lower rate than normal. Besides your country's prime rate, your credit card interest rate is determined by your credit score. A higher credit score typically means a lower interest rate, and vice versa. Credit history. Being responsible with credit and making on-time payments usually means a lower interest rate. And other personal data, like number of credit cards, what other types of credit you have, and how much you make. To figure out your monthly interest rate, divide your APR by 12. So if your APR is 24%, you pay 2% per month in interest. However, the interest charges on your credit card might be based on your average daily balance or your adjusted balance at the end of your monthly billing cycle. This is explained in your card's terms and conditions. For average daily balance, your balance is tracked daily, with new charges added and payments subtracted as you go. At the end of your billing cycle, each daily balance is added up and then divided by 30. For adjusted balance, you start with the balance from the end of the previous billing cycle, and all payments you make during the new billing period get subtracted from that balance. You have a grace period until the end of the current billing cycle before new charges start accruing interest. The best way to pay less in interest is to pay off your balance in full every month, and early enough in the month so it doesn't calculate. Since your interest charge is usually calculated on the statement closing date, paying as much as you can before that date means there's less to calculate interest on, so you pay less. So what's the bottom line? If you're looking to use a credit card, paying interest is part of the deal. However, how much you pay can be controlled by paying off your balances as early as possible, which will also help your credit score rise. And that, in turn, will likely earn you lower interest rates and higher credit limits in the future.